Good afternoon, everybody. Thank you for joining us for this discussion on understanding and managing different climate risks. My name is Sophie Robinson-Tillett. I'm the editor of Responsible Investor, and this is DigiFest, as many of you will know by now. I'm delighted to be joined by 4 experts on this topic. We've got a lot of ground to cover, and to do it, we have Viola Lutz, Head of Investor Consultant Climate at ISS ESG, Emilie Mazzacurati, Founder and CEO of 427, Julie Gorte, Senior Vice President for Sustainable Investing at Impax, and Gerald Esono, RI Analyst at Ilmarinen. Ilmarinen, that's always a tongue twister for me, Gerald. Ilmarinen Mutual Pension Insurance Company. I write about it often. I don't say it very often, but welcome all of you. I started off by saying good afternoon. That's not really fair for some of our panelists. I have to say a special extra thank you to Julie and to Emilie, because I believe it's 5 a.m. and 6 a.m. where they are. If there's one thing more commendable than being at work at your desk at 5 and 6 a.m., it's agreeing to try and speak coherently about climate risk at 5 and 6 a.m. in the morning. So a special thank you to both of you for being here. Before we launch into the discussion, just a quick thing for any of the audience members who aren't familiar with this platform and haven't been on any of the previous DigiFest sessions. There are 3 tabs on your right-hand side. The first one is will link you to booths, which you can talk to some of our panelists afterwards and continue the discussions. We'll come back to that at the end to make sure you're clear on what that is, but those are the links and what they're for. There's also a Q&A section. Please use it. It's really important. This topic is really complicated and there's so many questions to be asked. There's so much to talk about here, and these are the right people to talk to. So please ask questions. I may touch on them throughout, or I may address them afterwards, but they are very, very welcome. And there is a handout section finally in that 3rd slot where you can see some of the additional background reading that might be helpful that some of the panelists have suggested, and also the slides that are being presented can be downloaded from there. So that should be everything that you need to know to make the most of the session. The only other thing to say is that it will be available to listen to afterwards. So if you have to dash off for any reason, you can always come back and tune in later. Now, let's get into it. Julie, do you want to start us off? We're talking about understanding and managing different climate risks. So I guess the starting point would be to identify what the different climate risks that you as an investor would look at. Can I ask you, before you delve into that, just in 30 seconds to just explain who you are and your role, just so that everybody knows the perspective you're looking for? And I'm going to ask everybody to do this before they kick off too.
Sure. Thank you. And it's a great pleasure to get up at 5 in the morning to be with you on this webinar. I'm Julie Gorte. I am the Senior Vice President for Sustainable Investing at Impax Asset Management, LLC, which is the US side of Impax Asset Management in London. My role is basically, I think of it as connecting dots between the parameters of sustainability and financial outcomes. And you'll be glad to know that most of those are positive, especially actually in crises and downturns. As for climate risk, we often classify climate-related risks we put it in 2 buckets to start with: physical risk and transition risk. Transition risks are the risks that arise from the transition that we simply have to make to a lower carbon economy. Many of these risks are attached particularly to the big emitters, and the most carbon-intensive sectors are, in descending order, utilities, materials, energy, and industrial. So those are the ones that we often think of as being at the greatest risk for the transition to a low carbon economy. Now, there are various risks within that transition risk category. We're all pretty familiar with the first of them, regulatory risk, or the risk that some assets will be stranded or business costs will be increased through regulatory action, such as the imposition of carbon taxes or cap and trade systems. Carbon Tracker has done a bunch of really good work showing what the stranded assets are and assessing the reduction in value to those assets if you're curious and want to go for a deeper dive. Just to illustrate that this is happening in real time, BP, like 2 days ago, reduced the value of its oil and gas assets by $17.5 billion. So I guess that was on Monday, in recognition of the assets that could be impaired as the world pursues the target of a Paris Agreement. Another category of transition risk that applies primarily to big emitters is reputation risk, and a third is litigation risk. But they kind of go together, but not necessarily. Reputation risk is really hard to measure precisely, but considering that 84% of the value of the S&P 500 on average is made up of intangibles, it's fairly clear that a major hit to a company's reputation can drain away a whole lot of value before the stock price is bolstered by the value of bricks and mortars. So reputational risk can be really, really important, especially for consumer-facing emitters. Litigation risk is increasing. As of May, and there was a very good paper on this on the LSE Grantham website just a couple years ago, or last year. As of May 2019, there were over 1,300 climate change lawsuits filed in nearly 38 countries. But over 1,000 of those lawsuits were in the United States, which frankly, they belong there. Governments are the main defendants, but many are also filed against corporations and industry groups. And for corporations, well, we haven't seen a major loss from one of these. There was a pretty high profile case in the US a little while ago against ExxonMobil for concealing what it knew about climate risk for a couple decades before it finally went public with that. And they won that lawsuit, but they probably still had to spend millions of dollars defending it. So these things can still be consequential for companies and their investors. Finally, there are transition risks that can affect any company, even if it's not a big emitter. So shifts in tastes and preferences and changing technology are features of the low carbon transition, and companies that don't keep up risk losing competitiveness in customers. And even if they're up on the trends, they could still face transition risks. For now, just a quick example, kind of a no-brainer. As electric vehicles rise and their market share increases, new producers that don't have existing plant and equipment and workforces that are specialized in making internal combustion vehicles could be at competitive advantage, and those that make internal combustion vehicles could be a competitive disadvantage in capturing the newly growing markets for EVs. And then finally, there's physical risk, which is the sort of other half. There's transition risk and physical risk. And despite the hundreds of billions of dollars of value vulnerable to transition risk, physical risk is likely to dwarf transition risk. So that's it in a nutshell.
Thank you very much. You made it sound so simple then. On the physical risk side, briefly, can you just talk a little bit about where we're at? Because I think there has, as you point out, been a big focus on transition risk and on some of these other, risks that fit more under the transition category. But, physical risk is a big deal. So just briefly, your insights, if you will, on how far we've got with physical risk from an investment perspective.
So how far we've gotten, we are approaching step one. Right now, most of the investment world is either at the point of figuring out what physical risk really looks like and how vulnerable the assets in the portfolio are to it, or they're approaching that point. I don't think anybody's really mastered it yet. If they have, they're not talking. And some investors may not take it seriously, even though that is changing really fast. 5 years ago, nobody would have heard of transition risk except for climate nerds. And now I think most people probably have at least heard of it. Various estimates of the size of physical risk exist, and anything that purports to be global is measured in the trillions of dollars or equivalent chunks of GDP or income. So an often cited paper from Nature estimates the value at risk around 2.4 trillion, but notes that tail risk could be an order of magnitude higher. CDP recently reported that 215 of the world's largest companies report that they see almost $1 trillion in value at risk from climate change within the next 5 years. Losses to all assets over longer time periods are far higher. Another estimate puts the value at risk on the order of 20% of global GDP, or as high as 20% of global GDP. Most of the estimates take us through the end of the century, and absolutely all of them are underestimates. None of them incorporates the impact of things like tipping points, like what if we did melt all the methane in Siberia? Or the specter of mass migration or conflict occasioned by things like persistent droughts, catastrophic flooding, or the inevitable displacement that will happen as a result of sea level rise. So investors are working to understand what assets are vulnerable to what physical risks. And from there, I will let Emilie take it because she is an expert in that.
Well, I'm going to bring Emilie in a moment, and I noticed that there was a lot of nodding going on, so I know there'll be plenty to say, but I'm going to wheel back a little bit first and talk a bit, or ask you, Gerald, to talk a little bit about regulatory risk, because I think from your perspective, and maybe you can just introduce who you are and what your role is so that we understand where you're coming from on this, but regulatory risk is front and centre at the moment of how you're approaching climate risk in your role at the moment. So who are you to start with, and then how are you addressing climate risk?
Yeah, sure. No, thanks, Sophie, and good afternoon, everyone. Good morning, everyone, as well. As a brief introduction to Ilmarinen as a company, so we are a mutual pension insurance company based in Helsinki, Finland. We manage statutory statutory pension and earnings and pensions for 1.2 million Finns working and living in Finland, and one of our main goals, and I guess one of our key values in order to do this is really to try and finance, current and future pensions in a profitable, sustainable manner. One of our core values here is obviously the fact that I think our responsible investment policy, in a nutshell, really is all about capturing three big issues here, which is being compliant with international norms, being an active ownership, and continuously engaging with our investees, and also a key focus for sure is integrating ESG analysis into the investment decision process. When it comes to, a lot of these things, and I think what Julie pointed out, there's a lot of complexity and a lot of moving pieces in all this. But to kind of summarize, let's say, our approach to thinking about these issues, I think one of the key things that we have done so far in this current moment in time is to really invest in our ESG analytics and climate scenario capabilities to try and talk to the way our portfolio managers are making their investment decisions. I think that's really key. I think one of the key pieces here to come out of that is the fact that we're always focused on what is actually material, and when it comes to environmental and climate and climate risk, regulatory risks is one of the centerpieces in all this, because we believe at the end of the day, with the rise of what's happening, especially in the European Union with the EU taxonomy, this idea that we can start slowly being able to have let's say an accountability kind of framework to know, okay, these are the assets that are stamped green, and try and allocate capital in towards a low carbon economy is essentially crucial. Another key point, I guess, to highlight on the transition side as well is the fact that there's also a big technology kind of piece in all this. So a lot of the things, such as I don't know if you've heard of it, but you could also Google this, is power to X, this idea of where you can essentially try and transfer some of the excess base load from renewables into other baseload inputs into the power grid. That's a key piece, but and hopefully I'll be able to kind of explain more in detail some of the nitty-gritty on how we connect that together.
Yeah, so talk me through, if you will, the process. So in terms of the risk component, you make those assessments. What do you buy in data and then use that as a way of assessing what risks on which companies you need to deal with, or what's the process for you as an asset owner here?
Yeah, no, sure. So, in the three requirements that I just highlighted earlier and how we carry out our responsible investment policy, one of the key things that we really do try and, you can think about it in this way. There's, let's say, a lot of the carbon data is backwards looking. So a lot of this stuff, in order to kind of quantify and measure this risk and how we can actually get more informed decisions on whether to invest in a particular asset is to really monitor some of these data points. So we pledge to the Montreal Carbon Pledge. So a lot of these. So what we do is we report on our carbon footprint, but as well we also integrate a lot of ESG assessment scores that is provided by various ESG providers, and that gives us a better, let's say, understanding of framework on where to tackle some of these key issues. So we're tracking, for example, carbon emissions target, their years, carbon emission baseline targets, in order to kind of engage with the fact that what is being stated by the companies and what they're actually doing. If we can track that, that's a key way of trying to, I guess, manage the risks attached to that.
Great. Okay. And you mentioned scores. Then if you've got a whole universe of companies and you're looking from an equities perspective, if I understand correctly, you have these scores. Do you exclude anything, or are you mainly looking at the risks?
Yep.
Go on.
Yeah, sure. No. We definitely exclude. We have an exclusion. Let's say an exclusion list. So a lot of when it comes to climate risk, for example, we exclude companies which have been assessed with. We exclude companies with businesses, the business operations that have high carbon risk attached to that. So that's excluded. The threshold is currently at 30%, and with that we essentially combine norm. How would I call it? Like international norms scores together with ESG scores to come up with our own assessment. To come up, essentially like a traffic light system, so our portfolio managers are able to essentially, see which companies are at risk, have a high carbon risk attached to them.
Okay, so some companies, based on the data and the scores, are just simply ineligible for consideration, and then there are others that you then manage more closely and provide a kind of ranking to in terms of climate risk, and that's an ongoing process. Is that a fair way? Right, fantastic. I understand. Yeah. Oh, that's very data heavy, I think. Are there challenges around data? We've just had a question in from somebody who said, do you have enough emissions data to track this stuff comfortably? So, I mean, what are the challenges from an asset owner perspective on data to help you with climate risk?
Sure. I mean, this is an ongoing process. I mean, a lot of the ESG providers and specialist data providers on carbon have done really a great job in trying to flesh some of these issues out and trying to make this data as transparent as possible. But like, one of the key issues that we find with the data is the fact that a lot of this emissions data is pretty heterogeneous. So they're coming, a lot of companies are reporting it on the carbon emissions that you're seeing. Is that aligned with another company? Are they the same years, for example? Other companies are disclosing absolute reduction numbers, where others are reporting on intensity reduction numbers, and some are doing both. So it's really a question of really trying to essentially just try and track them and then come up with a systematic way of doing that, which through our let's say our proprietary analytics tool, we can essentially do that. Okay, so you use kind of in-house crunching to deal with some of the data and some of the issues there. Viola, can I bring you in, if I may? Firstly, I mean, I will ask you to just introduce yourself as well, because you come from a different perspective. We've had 2 investors so far. But I mean, I'm curious to know what your thoughts are on the availability of data for capturing climate alignment. Is probably a poor term to use, but you know what I mean.
Yeah, and thank you, Sophie, for that. So first of all, thanks for having me, and good morning and good afternoon and evening to everyone out there. So I'm head of investor consulting at ISS ESG, and briefly on ISS ESG. So we are an ESG analytics and advisory company. And what we do is we support investors to integrate ESG data across the entire value chain. So like Gerald said, in the portfolio analytics section of the work that's being done, but also on the pooled engagement and voting side of things. And indeed, it's quite interesting to see, in a way, the picture is getting better in terms of data availability, and in a way, it is not. So let me take that apart. So it is getting better. You can see it on the slide. So we've recently done a review of where have we come in the past 10 years on carbon reporting from companies. And the good news here is you can see the little bar charts, they go up towards the right? So the gray bar chart is higher than the green one. That means more companies in a specific industry are reporting. But if you look at the absolute numbers, it's still not that high. And you would have expected, with all the dynamics around climate, that you saw an exponential curve in terms of how emission reporting has gone up. And that clearly has not been the case. We still have around only 4,000 or so companies globally reporting of publicly listed ones. And of course, we are dealing with that in terms of reporting and kind of our own estimation models. And we do, Gerald just mentioned it, it's key to kind of clean the data, not take all the reported values at face value. Sometimes you have to discard them because they're not consistent. But I think the other element is indeed to also look not only into what companies are reporting, but to complement that always with an analysis of what companies are doing. Because if it's one thing that companies are always very willing to talk about, it's about their products and services, because they're commercial and that's what they sell. So looking into that and looking what share of their product and service portfolio actually aligns with climate change mitigation targets, and how has that evolved historically? And ideally, if a company discloses it, what is the target setting? That can give you, I think, a very interesting additional data point in that context.
Lovely. Okay, so some definite challenges there, but that's an interesting chart. It's a revealing one. Gerald, you do engagement. You and your colleagues do engagement as part of your responsible investment strategy. What's the role of engaging with companies to push them to disclose data that will enable you to manage these risks and will change that bar chart that Viola has just?
Yeah, sure. No, what Viola highlighted there is certainly like very interesting, because what we do, for example, is, so we are part of the Nordic Engagement Corporation. So we work together with PFA and Foxum. So there are other pension funds based, PFA in Denmark, Foxum in Sweden. And one of our initiatives that we were working on, and coming to the end of last year, is on TCFD reporting and disclosure of companies being able to disclose a lot of these carbon risks and disclosing them in a standardized manner. So we're currently engaged with a focus list of companies, and that's an ongoing process at the moment.
Great. I've had a question in which I may come to afterwards, but I'm going to hold it for a second. It's coming from one of our audience members. But I want to bring Emilie in, if I may, now, because engagement is a big part of this puzzle, and it's not just on transition risk, and it's not just on disclosure. There is the vigorous nodding that was going on earlier around physical risk has a role to play here. So do you want to just tell us who you are, and then talk a little bit about the role of engagement of physical risk, if you will?
Sure. Can you hear me? And good afternoon, everybody. Good morning here from California. So I'm the founder and CEO of 427. We're a risk analytics firm specialized on the physical impacts of climate change. I founded the company 8 years ago, so I'll let you calculate how much of a climate nerd I am in Julie's world. And just to mention, 427 is a majority-owned affiliate of Moody's. We work closely with our colleagues across the organization, but I am not speaking on behalf of, or do not represent, Moody's Investors Service, the ratings agency. Having said that, I can now move on to tell you what I think, and specifically to Sophie's question on the use of corporate engagement for physical risk. That's something that investors may not always think of. There's a lot of well-established experience and success in engaging on transition risk. And yet engagement can be used for the exact same reason for physical risk. The first one will be increasing transparency and pushing corporations to disclose more privately, publicly, but making sure that as an investor, you will have the information you need on the exposure of the business, as well as on how they're managing this risk. And then maybe even more importantly, it helps build capacity, adaptive capacity. It pushes corporations to actually make sure that they themselves have this understanding that they address the topic and that they are able to show that they're doing what it takes, that they deploy capital, technical assistance, that they are building resilience. Part of the question can be, how do you identify the right corporations? Where do you focus your efforts? And here my advice would be, first start with the corporations you're already engaging with. If you're working with oil and gas, industry, utility, those are sectors that have high exposure to physical risk as well. They have long-lived assets with a lot of asset value. And so they need to be looking at those risks. And generally encouraged to really try to understand what those risks are before engaging with the corporation, so that you can maybe prod a little bit if the corporation isn't forthcoming, or make sure that you can point to specific questions. Tell me more about how you're dealing with water stress in this region where your facility may need a lot of water. How about past exposure to hurricanes or typhoons? How have you responded to that? What does it tell us about the future? And I'll just flag here that on our booth, and I can put it in the link here, we have a report on engaging for physical risk specifically.
Great. Yes, I should say again that at the end of this session, you can go to the Expo button and then you can check that report out and chat with Emilie there more on this. But that's not the last that we will hear from you, Emilie, today for sure. So, Viola, can I come back to you now? Because engagement is one piece of the active management puzzle, as it were, when it comes to managing climate risk, but it's not the only piece. You look at this more broadly. Can you talk a little bit about some of the tools that investors are using on the active side?
Yeah, absolutely. And I think here the key word is definitely active ownership, whether that's via engagement that Emilie touched on, or voting. And I want to maybe just draw a couple of conclusions also for the current voting and proxy season that we see ongoing, because I find it very instructive, because we've seen a lot of very widely and controversially held discussions specifically on climate, and indeed specifically also on anything that you would broadly bucket into the transition risk climate element. And of course, we don't have all the final stats yet, but just to give you a little bit of the tastes of the dynamics we see more broadly going on, I want to at least formulate a couple of key takeaways that we have drawn so far from that space. And that is that high-profile dialogue is definitely increasing. So we have seen a continued trend of asking for more disclosure and target setting by investors, notably, for example, on Scope 3 emissions for oil majors. And BP, Eni, Repsol, Total, and others have recently announced climate commitments. And that was following dialogue with investors. And I think that is key. The companies are starting to really engage and act on the dialogue with investors. At the same time, for those where there's not as much active dialogue going on, or it's perceived as not being fast enough, shareholder proposals continue. And we did see several climate-related proposals also this season get a majority vote, for example, at Chevron. What's key to understand in terms of the dynamics, even if these votes don't get majority, but a substantial or amount of in favor votes, that still prods companies to the discussion table, because suddenly from a sphere 5 years ago where climate proposals would not get any majority vote, suddenly they've become a real possibility to get a majority. So I think that's important. And the other topic I want to raise is that we continue to see new topics moving into this active ownership circuit. And the one I would highlight for this proxy season is probably climate lobbying. So increasingly on climate lobbying, transparency is being asked for. And who knows, maybe next year or the year after, physical risk will be the big topic on the circuit. And one point, transparency. I think transparency is such a keyword here. you can really ask for that transparency. I think you can always debate whether or not at a given point you really know the best how a company is specifically performing. Of course, a company itself will always know best what they are doing. And when you look outside in, you will need to work with proxies for different data points. But you can really judge where a company stands in terms of this disclosure. Sorry, I'm sliding through because I want to show you just one brief element. It's maybe a little bit small here, but one element we look into, for example, for our climate change policy for voting, is we look into climate disclosure along companies' TCFD pillars. So across thousands of companies, we look, okay, according to their own documentation, how good are they actually in disclosing along the recommendations from the TCFD? And to sprinkle a couple of stats here in again, so more than half actually of these companies do not meet the standard across any of the TCFD pillars. So neither on governance, nor on strategy, nor on risk management, nor on metrics and targets. So that means engaging or being active in using active ownership strategies such as voting to, at a minimum, prod companies into more transparency, I think is very much key and needs to be looked into.
Great, that's interesting. And those slides, for anyone who can't see them, I've got a little computer screen with me at the moment, so they're peering at it, but they're available for download on the right-hand side in the handout section, so people can take a closer look at those. Just before I move on, Viola, you touched on possible areas that maybe next proxy season might come out as themes when investors are using voting to deal with climate risk. You mentioned lobbying. I would like to add in that it seems that there's also a growing trend for dealing with board composition on this, which I think people are seeing increasingly as a risk. I wonder if anyone else on the panel has any kind of predictions or even hopes for what might start coming through from a voting and possibly also engagement, but on a voting perspective over the next proxy season or two for managing this. Anyone?
I mean, happy to add maybe just one more flavor, and that is, I think, anything that relates ESG metrics to executive compensation. So not only board skills, but also executive compensation. And that's more broadly speaking for ESG and trend, we have seen that management compensation is more linked to achieving actual ESG metrics. So far, the focus actually has been more on social. So I do wonder when that will spill over to environment and climate more specifically.
Yeah, we are seeing some corporate commitments on that, but not so much stuff on the ballot. Anyone has any other? You're not obliged to if you don't, but I just wondered if you did.
We've been engaging some companies on physical risk, actually, just starting to do that. And what we've found so far, well, it's not a lot of companies that when we start asking them about physical risk, most of them are thinking about it, but few have done it. Often they're thinking about it because they've had something bad happen. Like Agilent had one of its headquarters burned down in the Santa Rosa fire, and that kind of hit them, like, hey, this could happen again. Another one that we just engaged with, when I told them what we wanted and we needed, in order to do physical risk assessment, you don't need the country of operation, you need the latitude and longitude. And they were so interested at the end, they said, well, sure, we'll try to provide that to you, but then could we have the results of your analysis when you're done? I mean, I think they're just as curious as we are, to be perfectly honest. And, it's kind of an interesting engagement to do.
Okay, interesting. I'm going to stay with you, Julie, if I may, and talk about scenario analysis. So we heard a little bit about the TCFD. We still have that slide up there. A big part of the TCFD is this forward-looking element, which I think has been a bit of a game changer in terms of the conversation around capturing climate risk. But it is, of course, broader than just the TCFD, and there's tons of stuff going on around it. But what role do you see scenario analysis playing from an investor perspective in kind of managing these risks?
Well, so as you and Gerald and pretty much everybody else said, investment is about looking forward. It's skating to where the puck is going to be, not where it was. So scenario analysis, the way you try to understand what the future could bring. And that's particularly important with climate change, because this is a future that no living person on Earth has ever experienced. So, we're dealing with something where we really have to lean on the science, on the climate science, to understand what's going on. So scenario analysis is something a lot of investors are beginning to approach, and some have actually done a bit of it. We have at Impax examined or are in the midst of assessing several of our portfolios according to 3 IPCC scenarios. Simply put, scenario analysis is a test of the vulnerability of an asset or a portfolio of assets under different scenarios, like RCP 2.6 or 4.5 or 8.5, or if you speak English as opposed to IPCC, that means meeting the Paris targets, business as usual, and the third, which I call it the let it rip doomsday scenario, where we might actually interrupt the thermohaline deep ocean circulation, which might make people in the UK realize just how far north they really are. We can't predict exactly what's going to happen. You can't forecast the next hurricane or the next drought. And since controlling emissions is something, it takes something that we have very little of on this globe, namely concerted cooperative action, we need to assess the value at risk under different scenarios so we can prepare for it, because we may not take that concerted action. We may actually be, heading for the doomsday scenario. All of these kinds of changes are going to happen over decades, but the events that they will bring with them tend to occur suddenly in ways that we can only understand in terms of probabilities, but we can't predict with any accuracy in time. For long-term asset managers and owners, scenario analysis is one way of understanding the value at risk and preparing for a world that no one has any experience with. Anyone who doesn't do that will just face a future of increasingly severe and unpleasant surprises.
I know this sounds very basic, but I mean, given that we don't know what's going to happen, how useful is scenario analysis for managing those risks? I mean, we talk about it as if it's a given thing that it's going to help, but then, investors are using different scenarios, different data, the information is not necessarily there, there's different timeframes. What is it doing, the scenario analysis, really to help manage those risks, given that they are quite unpredictable?
So I think one of the things that our portfolio managers have told us is that if they have a choice between two firms that pretty much do the same thing, have the same sort of business model, and one of them has all of its facilities and assets at sea level, and the other one is all inland. Now, there is a big difference in the kind of risk that they're going to face from severe storms, coastal flooding, and sea level rise. That can help you sort of figure out a little bit, what's your risk premium that you're going to demand for the companies at more physical risk. Moreover, you can engage with those companies so they know at least how you're looking at the physical risk, and then they can make their own plans and preparations for how to deal with that. You can't avoid all the risks, but you can definitely prepare for them and be more resilient. We, for example, changed all of our backup business because we're a mutual fund company, and even if we have a storm, and we're in London and Portsmouth, New Hampshire, which means we're both at sea level. And if we, get knocked out for something like that, we want to make sure that our backup facilities aren't in Louisiana, so they're inland, higher up.
Okay. Emilie, physical scenario analysis. I'm getting all my lingo mixed up. There's less been done so far by many investors on this, but there's a lot that can be done. Can you plunge in and talk us through?
Yes, absolutely. And Julie's touched on a lot of important points. So I'm going to try to build on what she already presented. The one thing that I want to highlight here is when you think about transition risk and physical risk, you might want to use different drivers, different specifications for your scenario. And let me flesh that out a little bit. IPCC scenarios, which Julie mentioned, represented on the left-hand side of this chart with the transition risk, give you a view of how things are affected by policy and socioeconomic so-called pathways. So what kind of future, how many people on planet Earth, what kind of economic growth, and what kind of technology do we use? How does that drive emissions, right? And that gives you those very clearly, neatly differentiated so-called pathways with high emission, medium, low emissions. Physical risk is not, it's of course very much influenced, that is the whole point of the policy, but it is not as neatly differentiated as you can tell from the other chart. And what I mean by that is that the impact of policy decisions that we may take today will not manifest until, there's going to be a lot of lag and policy between the time that the policy is put in place, and the impacts on the climate change. So if you're looking at short term, which in the world of climate nerds means about 20 to 30 years out, you are going to see we're locked in a certain amount of emissions that are due to the historical emissions and current emissions. Even if we stop carbon emissions tomorrow, we're still going to have a lot of impacts in those coming decades. And so that chart to the right shows you the model projections under the different RCPs going out to 2050. And as you can tell, they're all jumbled together. The uncertainty here is not driven by one policy scenario versus another. It's going to be driven by the uncertainty of how those impacts manifest. And Julie touched on some of them, which are not even necessarily captured in those charts, the typical parts, right? But even in the impacts that we understand and that we know, where we can see the trends around the heat, around water stress, around sea level rise within the known world, there is uncertainty. So if investors and corporations are going to look at scenario analysis, we think that they should be looking at a high and a low within that context, right? And that's really where the recommendations from the NGFS, the central banks, Bank of England, that are starting to pull out requirements for banks and insurance to do stress tests, are pushing the institutions to looking at a sort of a base case for physical risk, which is already going to be quite risky, and then an extreme or hothouse scenario. And the last thing I want to say is it's not a seesaw, right? You don't want to fall into the trap of thinking that if you have a rapid transition scenario, therefore you have low impacts. I would argue that it's actually probably going to be the other way, where high physical risk impact will drive a late, abrupt, disorderly transition. And so the scenario, the sort of the worst case scenario you want to plan for, is everything happening at the same time.
Yeah, I was going to say, actually, there does tend to be a very simplified explanation of sort of transition versus physical risk, where you only need to deal with physical risk if we don't deal with transition. But that's not a very accurate way of capturing these risks, is it? There's lots of heads doing things here.
Risks are in your base case, and then you make it worse for your alternative scenario.
Viola, can I bring you in maybe there, because you look like you might have some views on the physical side and on that question that I just asked.
But maybe just on the last point, whether or not physical risk only comes in when transition risks go up. I wish that were the case, but we've already locked in quite some effect for climate change. So whether or not we will have physical risk, that is a question that can only be answered with yes under any scenario. We have already answered that question as humanity. So now it's about how much and when and how exactly. So I think that's just very important. So look at physical risks, look at transition risks. I think one important element is, I think now the importance of physical risk is being increasingly understood. But I do think it's important that it does not become a box-ticking exercise, because it's, of course, quite complex. It's complex in the sense of the climate science that underlies it, but it's also quite complex in terms of the time horizons and probabilities that are involved in it. So, and you can, because of all these different dimensions, you can slice and dice physical risk data in so many different ways, and then you can translate it into a lot of different types of metrics. And I think it's important that you know, as an investor, what do you want to find out when looking into physical risk, and what do you want to do with it as well, right? Because that will inform what you need to know about the data you're looking at. One example that I always find, it's so obvious once you've heard it once, but you need to hear it at least once, because the level of damage potential, for example, you can express in a metric. It can either give you the additional climate risk, so the additional damage potential resulting from climate change, or it can give you that additional level of risk plus the risk that was anyway there, even in the absence of climate change. And that can give you two quite different numbers, right? And I think it's very important for you to know what of these numbers are you looking at when, for example, engaging then with a company. And I think on top of that comes another fact, and that is that, as with transition risks, the most detailed information on what a company is doing where, with what type of assets, still lies with the company itself. So the second element I would like to highlight, especially since we're dealing with so many uncertainties, is that companies themselves do need to have good management in place. And I think one of the key drivers that investors can do is to actually activate the capacity building within the companies based on a heat map assessment, for example, of their portfolio. So I think that is really key to get kind of the adaptation planning and CAPEX planning integrated with physical risk considerations as well as transition risk considerations.
Good points. Julie, Gerald, do you have anything to add from an investor perspective in terms of physical risk data or any of these kind of the framing of physical versus transition risks? Anything that you want to add in?
I mean, I think what everybody just mentioned in the panel is, it really hits the nail on the head in terms of how complex these issues are. But I think from Ilmarinen's perspective, I think one of the key issues for us is when we are also carrying our own scenario analysis, which we use the IEA Sustainable Development scenarios, is to essentially use this as a key piece in how to essentially engage with companies and the boards in a more focused approach. Like how are they doing? What sort of investments they're doing towards green investments and so forth. So in a way, it's almost just another way of getting that conversation really focused in order to kind of mitigate. In order for them to essentially see. In order for us to actually understand the risks involved. But also another kind of challenge that we're facing as well, and we're still thinking about, is like a lot of these models, it feels like we're going into like an alphabet soup of other models. There's PAGE, there's DICE, there's IMAGE, there's AIM, and for investor and especially for me who is in the trenches, it gets a bit overwhelming. So sometimes the practical aspect of trying to get this scenario into a practical kind of dimension and application of how portfolio managers can use it, that's a really big challenge, I believe. And just to finish off there, just the final point is a lot of these models, some of them probably wouldn't pick up a lot of, let's say, the political constraints that comes with what does a world look like in 20, 30 years time. So a lot of the policies will obviously be changing, and that will effectively also change the outcomes of how companies will invest towards this low carbon economy. So yeah.
Gerald, could I just ask you very, very brief, if you will? You touched there on the challenges of trying to get something that can be embedded into portfolio management. Is there anything the world can give you? If you had a magic wand and you could ask for one thing that would make this easier, is there anything that you know you need, or is it just a matter of seeing how things develop?
Oh boy, that is a big question. But I think one important one, and I think that's been highlighted by everyone here, is to kind of come up with a way where companies can disclose a lot of this information in a very systematic and in a transparent manner, and one where it's based on scientific-based kind of targets, or they're quantifiable and they're all transparent. I think that's one key issue, and maybe that will be one of the key things that we could make our lives a lot easier. But it's a common wish. Hopefully we will get there. I know that regulators are getting more involved to try and make that happen as well. Julie, was there anything that you wanted to add in on physical risk before I pass back to Emilie?
I already said this once, but I can't emphasize too much that knowing where a company's facilities are, and I don't mean every postal office, I mean facilities that if lost would have a material impact on the company, by specific, like a street address or longitude and latitude, is far more useful. The company says, oh, our locations are Shetland, Andorra, and Monaco. Great, that's one thing, but I don't know any company that would say that. Instead they say, we're in Russia and China and California and Brazil and South America. All of those locations have every single physical risk there is. If you want to understand the vulnerability of the company, you need to know where their specific facilities are. And just for perspective, there was a report from S&P Global a few months back that said 60% of the companies in the S&P had assets that were significantly exposed to physical risk. 60%. And that's as we're just beginning to understand this stuff. So, I can't say too much. Investors can do a lot with data, Without it, we can make a lot of assumptions. If you were a company and you were being assessed by an investor, what would you want? Would you want to provide them with data so they really understood your risk the way you do? Or would you want them making assumptions? I know which one I'd want.
Good point. Okay, so that real physical, granular asset level data is going to be essential to that. Emilie, we've talked a lot implicitly about equities, not only, but we have been to, Gerald is focused on equities, and a lot of the conversation on climate risk and engagement in stewardship and voting focuses on equities. But there is, of course, a fixed income component to all of this. Can you just touch a little bit on this topic in the context of fixed income for us?
For sure, and in doing that, I hope that I can answer a little bit and speak a little bit to points that both Gerald and Julie mentioned. Gerald, to your point on how do you go from those really big picture scenarios to something that's actually usable for an investor? And Julie, to the point of what do you do when you have that very specific location? How do you turn that into a financial impact? And I want to shed a little bit of light on the work that we've been doing with Moody's Analytics on how do we go from this core data on physical risks, transition risk, those risks that Julie and others highlighted so eloquently. So the way we look at it, right, is thinking, as one should, about the many ways that those risks are going to affect the corporate value, the economy at large, and companies individually. How that's going to translate in terms of corporate financials. How does that affect cash flow? How does that affect capital, risk premium? And then feed that into traditional credit risk models, in Moody's case, the EDF model, which is one the most established model on the market to understand probability of default, loss given default. And so really go from this very granular assessment and identification of the risks in the first place, all the way down to how does that affect the probability of default. So I can expand a little bit, and I'll go quickly, but I'm happy to answer questions. I know there's questions for the panel as well. So thinking again about each of the relevant climate hazards in the case of physical risk, we're doing the same, of course, for transition, looking at the different policy technology risk, looking at scenarios in the big picture, right, per Gerald's point, and then looking at how different firms perform under those different scenarios, and therefore how does that affect their credit risk. And the last thing I want to flag is just this so very quick case study looking at Taiwan semiconductor manufacturing as an example. To the left, you'll see sort of point location, very detailed assessment of what their facilities are exposed to. In this case, we looked at hurricanes and typhoon. We do that for all of their risks, for all the large listed companies, looking at the risks side by side. And then you start thinking about what happens if a big typhoon hits Taiwan, right? It's not one dot, there's many dots in that place. Then you could see a sort of a drop in the asset value of the firm. And you can see how with the blue lines in the top right corner, the squiggly lines start crossing this default point, right? The point where that might affect credit risk. And that bottom chart is very loaded slide, sorry. Then you see how over time being on the horizontal axis, the increase in the probability of default under different scenarios, especially the light blue scenario being the hot house, the sort of extreme physical risk impact scenario. So this is the type of metrics that, from our perspective, investors need, where because everybody is starting to take physical climate risk seriously, then it's time to apply best-in-classes model to provide metrics that really fit into existing frameworks. This is not about reinventing the wheel. This is about, when you do scenario analysis, having this climate perspective embedded into your work.
Wow, there's a lot there, and again, those slides are available for people to have a closer look at all those squiggly lines. There's certainly a lot of information baked in there. So thank you very much for talking us through it a bit. I guess we should jump, if we can, to some questions from the audience because they've been coming in thick and fast. There is one that says it's from me. I don't know why it says it's from me because I promise it's not from me. So somebody's stolen my identity. but it's a good question, so I might claim it anyway. But how will alternative sources of data like satellite data change the understanding and management of climate risk for investors? So does anyone want to come in and answer that? Emily's got a hand up. Julie's nodding. Is that right? Okay, we'll start with Emilie. Could we keep it? I know it's a
Very
big
quick.
topic. Could we keep it a little brief? Yeah.
So satellite data is already a key input in a lot of that analysis, thinking about land use, wildfires, a historical view of those events. What the continued development in geospatial imagery is going to bring us is more real-time view, a more detailed understanding of those risks, and the ability, I think mostly from a risk management standpoint, to really see things and monitor as they happen in real time. So that would be the main thing I'll highlight here. Okay,
Viola, Julie, you both seemed keen to answer that. I don't know if Gerald is, but just jump in, Viola.
Yeah, I think the real-time component is key, as Emilie has said. I think the other element is double checking what's being reported by companies. I think satellite data is, if you think about, we've talked a lot about disclosure on this panel, but if you think about it, how can you challenge what companies are claiming sometimes? Satellite data can be a very granular way to do that and to engage on that.
We've had a few questions in about the role of supply chains in all of this. Now, it's a big elephant in the room because it's obviously another of those frontiers that we're just sort of addressing in conversations about this, I think, for most people. But does anyone have any views on the role of supply chains in risk management on climate? Are we there yet? Is it possible? Is the regulation going to help? What do we need?
We're not
really.
I mean, I think with supply chains, the more global they are, the harder they are to understand. But there are often bottlenecks or key points in supply chains that can affect everyone in an industry. So for a long time, and maybe even still, there was like one silicon foundry in the world. And if that thing got knocked out, everyone making microelectronics can suffer. So what that company's risks are is going to affect a whole lot of other companies downstream. When we talk about physical risk, really important to understand the supply chain. So not only do we need to know, where every company's significant facilities are, we need to know who the major players in their supply chain are so that we can understand their risks as well.
Yeah, quick point to add on to that, Julie, since you said earlier, right, you can only do as good work as the information that corporates provide. I'll say the most sophisticated corporations that we work with in helping them do their own assessments will also give us the location of their key suppliers so that we'll do the assessment of their key suppliers at the same time, and engaging with their supply chain is going to be a key part of their risk management strategy.
Maybe to add one last element, and that is, I think, what you already do have available more widely is information of company supply chain programs. So what are they paying attention to when managing their supply chains? It's not where it needs to be, and I think it will be interesting to see how different jurisdictions might pass additional legislation around that. But I think similar to what we've talked about for physical and transition risks, there's always the piece of what do you know, and the other element is how can you push companies to manage that? And I would say there are certainly initial steps you can already take with the data out there more widely.
Okay, and we talked a little earlier this week about some moves that the EU are moving to introducing to require companies to disclose more on the environmental implications of their supply chain. So that's due for next year and may also contribute to that, I think. Gerald, a question for you that's very specific, which is how do you manage climate risk for companies like the Finnish utility Fortum? So Fortum has a subsidiary called Uniper, which has got lots of lignite coal mines and has just opened a new coal plant in Germany and is suing the Dutch government for phasing out coal. So it's a controversial company. Possibly from an ethical perspective. Oh, we've lost Emilie. Emilie's just demonstrating a technology risk for us before we end the session. But in terms of the role of that when you're looking at risk, can you be that granular about what you're considering? Does it make a difference when companies are doing this from a risk perspective?
Yeah, I mean, this is obviously like one of the big challenging cases that we're currently working on. But just to highlight a few key pieces here. I think the most important thing that we're trying to do at the moment is to try and engage with the company as much as possible to give us those quantifiable numbers and targets that they're working towards in order to essentially reduce their absolute or intensive carbon emissions. This is definitely in the scope of our engagement work with a company directly, and you can have all the data that you want. At the end of the day, I think the most important thing is the data should just be like the key pieces of clues that you then take towards the company, and that's when you make that meaningful engagement with trying to see how they're seeing risk, carbon risk in this regard.
Okay, so engagement is the key then. We've run out of time, sadly. I'm sorry for everyone whose questions we couldn't answer, but Emilie, who's back, will be in the Moody's booth, which sounds like a sort of sultry 1950s jazz bar. I'm not sure if it's going to be like that, but it sounds like one. So you should go and check it out. You can ask her lots of questions. You can take drinks.
It's great.
You can take a closer look at all those slides and have those chats with her. Viola, I believe that you will be available for dialogue and private messaging after this as well. So get in touch.
The ISS ESG booth.
Oh, you are in a booth. Sorry, I got told that there was no booth for you. But yes, okay, ISS ESG booth. That's another tongue twister for today. So if you go to the Expo tab on the site, you should be able to come through and grill both of them. Julie, are you in any booth? Are you doing any private messaging? No, there's a shaking of the head. Go on.
Not, but I did notice that there was one question that was asked specifically on ERISA, and I'm more than happy to talk with that person. I'm not sure quite how, so I'll just put it in the question.
So you should all be able to contact each other outside this, but Julie, you can also answer it then and there. Sorry we didn't get time for it, but we did cover quite a lot of ground. So thank you very much, all of you, for your contributions. Thank you to everybody who listened and asked questions, and let's keep the conversation going afterwards. And I'll see you all for the rest of the sessions in DigiFest. Thank you very much.
Thank you.
Thank you, Sophie. Thank you, everybody.